Welcome to Lesson 6. Today we're going to discuss a central concept in financial accounting, one that tells us that when it comes to business, all roads lead to the balance sheet. Hello everyone, I'm Professor Matt. The accounting equation is a central concept in financial accounting. It affects every transaction a company makes. In this lesson, we'll define the core equation, see how different account types flow together, and look at a practical example of how the equation stays in balance. In our previous lesson, we discussed the 5 main account types. Today, we'll see how these pieces fit together. The accounting equation is the master blueprint for all financial statements. The accounting equation is this: assets equal the sum of liabilities and shareholders' equity. Simple, right? But this equation tells us exactly how every financial record is constructed. Assets, liabilities, and equity correspond to the balance sheet. Income and expenses correspond to the income statement, but even these income statement accounts ultimately flow back to the balance sheet. This flow is what the accounting equation is really telling us. It connects the daily activity of a business back to its overall value and ownership structure. Income and expense accounts are what we call temporary accounts. Asset, liability, and equity accounts are permanent accounts. The temporary accounts are cleared out at the end of every accounting period. When we clear them, the net income, the difference between income and expenses, is carried over to the balance sheet. This is why we say net income is ultimately a flow of value. Specifically, net income increases shareholders' equity. Assets are the resources a company owns, while liabilities and equity are the claims against those assets. That's why they must always be equal. Let's look at an example. Suppose a hardware store sells a hammer for cash. That transaction affects 2 accounts on the books: the cash account asset and the sales income account. The cash asset increases and the sales income eventually increases equity. Both sides of the balance sheet are affected equally, and the accounting equation holds firm. To recap, every transaction keeps the equation in balance. Understanding this relationship is key to understanding financial accounting. In our next lesson, we'll go deeper into these concepts by discussing the accounting cycle. I'm Professor Matt, and I'll see you in our next session.